I am a certified financial planner here in Belleville, and usually I give about 8 talks a year live to groups like Probus, like the Wellness Center, United Way. This year have not had a chance to do that for obvious reasons because of physical distancing. I've not had a chance to present. And today what I'm going to do is I'm going to share my screen, and it's going to be a combination of slides and drawings. So I'll share that, make sure that it's working before let's see which one's the right one. This should be it. So, okay, there. All right. So of course, this everyone who's here should be because you're interested in knowing the 3 top biggest mistakes retirees are making with estate planning and how to avoid them. So, so I've been a financial planner for 7 years now, hundreds of meetings with clients, and have my certified financial planner designation. And so for anyone who doesn't know what that is, these are the books. If you can see my window, I don't know if you can see it, but it's about 1,200 pages of textbooks that I had to learn, and a 3-hour exam followed by a 6-hour exam. So I'm going to go over all this information today. No, not really. I don't have time for that. So instead, I'm going to go over the top mistakes I see people making, the top 3 that I see with estate planning, and how to avoid them. Now, don't have a ton of time today. Usually I take questions as I go, but since we don't have a ton of time, I will take them at the end, and I'm very happy to answer questions at the end because I like to make sure that the presentation I'm doing is helpful to everyone. So please do, if you have any questions, please do stay until the end. I'll be happy to answer them. So, so just to talk a little bit about who can benefit from this talk, really at the end of the day, the people who can benefit, and I mean, this is to make sure that this is going to be of value to you. The people who could benefit the most from this talk is someone who is concerned about their estate. Now, it's not fun to think about. Anyone who's joining me on this, watching this, is in a minority of people that are concerned about this. A recent study said that Ontario, less than half the population even has a will. I think it's because people just don't like to think about, not always being here around their loved ones. So this is for anyone who's concerned, who says, you know what, I'm not sure what's going to happen when I pass away. Are the people that I care about, so this is a person who's confused about their state or worried about what's going to happen. These are the people that care about in their lives, children, grandchildren, loved ones, charity or churches that they might be thinking about leaving, some of their inheritance to, or their assets to. This is who this talk is for. And I have given talks where people said, Galen, I either am not concerned about this, or I just don't think I'm going to be leaving that much behind. Then this talk is not for them. This is for people who do know that they're going to have, in all likelihood, they're going to have an estate to leave behind, but they're just not sure how to do it in the best way. And every time I give one of these talks, also in executors. If anyone knows that they're an executor, or if anyone is thinking about naming an executor, so this is the executor group down here, who's going to be in charge of executor, in charge of managing the estate after someone is gone. I always hear, unfortunately, horror stories about people who've been executors of estates that were not managed properly and how difficult that can be. Now, so one of the things I'll say is, so I used to be a teacher. I have a master's in education, used to be a teacher, and my favorite way of working with students was one-on-one. I could answer their questions, I could help them. It was a great way to teach. As a financial planner, I'm usually sitting one-on-one with people, answering their questions, speaking directly to their circumstances. This obviously is not the case today. So if anyone's familiar with WebMD, I kind of compare it to, WebMD, which is a place where you can go online and you can look up, if you're not feeling good, you can look up your symptoms. You can get a rough idea of maybe what's going on, but it's not the perfect way to figure out. Most people need to go to a doctor to know 100% what's going on. So in this talk, I am giving general ideas as to what I see commonly happening. And I don't know exactly which one of these would apply to any individual person until I sit down with them. So don't necessarily go out and change anything about your estate just based on what I'm saying today. Certainly consult with your own advisors, tax, estate, or tax lawyer or financial planner. So very briefly about me. So I am probably one of the most interesting financial planners you'll meet. I have lived in 4 countries. I have 3 passports. I lived in South America for 10 years where I got my master's in education, which is why part of what I love about being a financial planner is explaining things to people simply in a way that an educator would explain. So this is me 7 years ago, right after I got licensed to become a financial planner. And these are my kids. They're much bigger now, but I used to be a stay-at-home dad. And when I came home from this 2-week-long training, it was the longest I'd been away from my kids. And so when I came home, they were very excited to see me. And so they wanted to play. I was exhausted. So that's me laying on the ground, exhausted while they are, doing like a horseback riding. Now, to talk a little bit about why I care about what I care, like why do I care so much about estate planning? Why is this a topic that's of top importance to me? So this is a picture of my grandfather and me. He unfortunately passed away when I was 2 years old, so I don't remember him. And unfortunately, he's a very intelligent man. He was an executive at Exxon. He started off in Texas pumping gas, worked his way up through the ranks at Exxon. Very intelligent man, but unfortunately he did make some mistakes with his estate planning. So that when he passed away, unfortunately, there was turmoil in the family trying to figure out what he wanted to have happen. People were fighting over what he said he would happen. People were contesting the will. There were a lot of problems, and it's just because he hadn't had the right conversations with the right people. He hadn't asked the right questions, unfortunately. And I think most people just assumed he had it figured out because, being a smart guy, he probably had it all figured out, but it was not the case. And so my passion is helping people make sure that that does not happen, because I don't remember my grandfather. I was too young when he passed away. And unfortunately, a lot of what I know about him was the years of fighting that happened after he passed away. And 10, 15 years later, I would still hear about it. And another reason, so this is me holding my own son and my dad holding me. My dad and I look a lot alike, obviously. So this is a picture taken 30 years apart. I was planning on having kids by the time I was 30, and my son was born 2 days after my 30th birthday. So so my own father, so when I became a financial planner, I was starting to have these conversations with people. What do you want to have happen? What are you planning on doing, with your assets when you're gone? And a lot of people had not thought about it. And I realized that I was being a bit of a hypocrite because I didn't even know my own parents' plans. And it's a very difficult conversation for a child to have with their parent, to say, so by the way, what do you have in mind for when you pass away? Not a fun conversation, not a fun thing to think about. But I am eternally grateful that I did ask my dad. So my dad is a retired doctor. He lives in New York City. Very, very smart guy. He was actually a part of a group of physicians that won the Nobel Peace Prize. I figured he had it all figured out. I knew he had a lawyer. I knew he had an accountant. I knew he had an advisor. So one day I sat down with him and I just said, Dad, what do you want to have happen? Like, don't worry about what I'm going to get. Don't worry about what my sister's going to get. Just tell me what you want to have happen when you're gone. God willing, it's a long ways away. Just tell me so I can make sure that that's what's going to happen. So he started to tell me, and I realized that he was on track for disaster, that what he wanted to have happen was not going to happen because he wasn't working with an advisor that understood all the different things he could be doing to make sure it happened. And I'll go into more detail in a minute, but basically he was making a lot of the same mistakes that a lot of people are making when I first meet with them. And luckily over time, I was able to talk with him and fix a lot of those mistakes. And my dad, as a bit of a side note, was one of the first people in New York City to be diagnosed with COVID 6 months ago. And I was very, very concerned that he might not make it. He's fine now, but he was not looking good for a couple weeks there. And the small consolation I had was that if he had passed away, I knew that it would be a seamless estate. God willing, he's going to live many, many, many more years. But it was the one thing I just didn't have to worry about at that time. I was more worried about making sure he was getting the right health care, make sure that he was in touch with my sister who lives closer to him. So that's why I care so much about what I do, and I've made sure that my own family is taken care of. I myself have an estate plan, even though I'm only 40 years old. I have one myself. So here are the 3 mistakes that I see people making commonly. And that is one, not knowing the value of their estate. So in the first place, just not having a clear picture of what their estate was probably going to look like when, either now, if something were to happen suddenly, or in the future. The second mistake is not using beneficiaries wisely. This is something I see very commonly. And this is the most common mistake I see, where people are paying more taxes than they have to when they pass away. Sometimes I see people losing as much as 50% or more of their estate to taxes, when they probably could have avoided it if they had made some decisions earlier on. So the first mistake I'm going to talk about today is not knowing the value of the estate. And one of the things I find, so I'm going to draw it over here a little bit, estate planning has gotten a lot more complicated in the last couple decades. So once upon a time, someone would be in retirement and their source of income would usually be a pension and maybe a few other savings. But it was usually, there wasn't as much to do when it comes to estate planning. Maybe they had a house, maybe they had a pension. Now it's gotten much more complicated, where people sometimes have a pension, they have like from a company that they worked for, sometimes they have old age security, sometimes they have Canada pension, and then not to mention all the other accounts that they might have, like, and I apologize, I'm using just the letters because I don't like using abbreviations, but to make it fit on the screen, tax-free savings account. People have RRSPs, RIFs. It's not uncommon for me to meet people who have, I actually talked to an advisor the other day. He had a client who had 13 different sources of income in retirement, different pensions from different companies, old age pension, Canada pension, RIF, TFSA, a LIRA. Those are things that companies sometimes give to people. Other things like just stocks sitting around. So this all makes it very much more complicated than before. And so a lot of people just have not taken the time to organize all this into one place, where they've just kind of taken a look at what's going to happen with each one of these accounts. What is each one worth? How much is going to go to taxes? That's the number one thing. And the number one thing I help my clients do is they say, what do you even have organized? This is something I did with my dad. We sat down and we listed it all, because he had all sorts of things going on that I didn't know about and wouldn't have known if we hadn't organized that information. So that's the number one thing, is simply not knowing how much people are going to have to leave behind in the first place. The second mistake is not using beneficiaries wisely. So I'm going to talk about that a little bit. So beneficiaries, in case anyone's not familiar with the term, beneficiaries is, someone that you can name that's going to receive a property or an investment. And I'm going to zoom in on this for a second. I'm going to talk a little bit about this. So this is what I call the one-page estate plan. And basically what it covers is that when people pass away, there's a thing called, if you talk to a legal term, it's called deemed to disposition. It's a fancy word for everything that is in your name is sold. And if you have, so one thing I'll just say quickly is spouse to spouse. If spouses are named as beneficiaries or joint owners of things, that's usually fairly smooth. It's really the next generation that I'm talking about. So, I mean, just to draw that out a little bit, sorry, that's coming out a little bit crooked here. So if you've got spouse to spouse is usually fairly straightforward. If they've named each other as beneficiaries, it depends. Some people, if it's a second marriage, sometimes they are not naming each other as beneficiaries. But if it's in the case of, one spouse to another, things usually pass fairly straightforward if that's what they've decided. What usually where the problem comes is when it goes to the next generation or to a church or a charity and that someone has in mind. That's the line where things tend to get taxed. And so when someone passes away, basically everything they own is deemed to have been sold. And one of the first things is taxes are due. And so when I sit with people, I first ask them, what do they want to have happen? Which is up here. I say, how much would you want to give to your loved ones? How much would you want to give to the causes you care about? I'm going to zoom in a little bit because that might be kind of small. how much do you want to give, how long do you want it to take? Because that's another big aspect of estate planning, is how long it takes for things to settle. And then what would actually happen. And of course, no one's ever told me that they wanted to give more to taxes than they than they have to. Quick disclaimer on taxes: I get why we pay taxes. I understand that, but I just don't like seeing people give money to taxes that they could have given to their children, to their favorite charity, or to their church. So I'm a big fan of saving that. So this is the second mistake: is really when people don't know what's going to go where, and they haven't used their beneficiaries wisely. And by that, I mean, there are accounts that can have beneficiaries on them. So for example, the RRSP, you can name a beneficiary on that. And when you name a beneficiary on something, it doesn't have to go through the estate normally. A house can go through the will, but so a house goes through the will. RSP, you can name beneficiary. Tax-free savings account, you can name beneficiary. In these two cases, they don't have to go through the estate. They can go sort of around the estate. But the next thing to take into consideration is taxes, which I'm going to talk about, because while the tax-free savings account can go tax-free, the RRSP does not typically go tax-free. And that's where most people lose a lot to taxes that they could avoid a bit. And that's what I'm going to talk about next. So the third mistake is paying extra voluntary taxes. So I see this a lot where people are not planning ahead, and they're simply going to let, if you don't plan ahead, the government is going to, they're going to take what they're going to take because it's the law of how much they can take from taxes. But if you plan ahead, you can actually avoid some of it if it's going to be a problem. So the first thing is to find out how much the estate is worth, how much is going to go to taxes, and whether there's something we can do about it. So I call it the red bucket and the green bucket. Now this is, I'm going to spend a little bit of time on this because it is a bit of a complex concept, but basically you've got things that are, I'll see if I can do a color here, and if you can still see it. Can you still see that fairly well? I'll try to zoom in a little bit. Karen, can you see that okay, or?
Yeah, that's perfect.
Okay, so green bucket and red bucket. This is not exactly red, but it's a decent color. So what I mean by green bucket and red bucket is, so the red bucket is the things that are going to be taxed. And the green bucket is the things that are not going to be taxed when someone passes away, or they don't have to be, I should say. So, and then there's some things in the middle that I'll talk about, and I'll talk a little bit about the will. I'm not a lawyer, but I am a big fan of everyone having a will. Last year I gave a talk at the Wellness Center about, for United Way about, it was Will Week, and a lot of people came out to figure out, a lot of people don't have wills. I highly recommend people get them because it just makes things a lot easier for the executor and everyone in the family. So the green bucket are things like, so what I'm talking about here is, let's say here's the person who's concerned about their estate, and here's the person, the children, grandchildren, or loved ones who are going to inherit it. Like I said, spouse to spouse, if they've named each other as beneficiaries, there's not usually a problem here. It's when it has to go to the children, grandchildren, church or charity. That's when this gets, when someone passes away and it's going to go to another generation, that's when they get taxed. So the green bucket is tax-free savings account, the house. Your principal residence will not be taxed when you pass away. If you have a cottage or something like that, it could be, but not your principal residence. And life insurance. These are all, these are all things that are in the green bucket. So these are things that you can, that don't have to go, so these are not going to be taxed. So the tax-free savings account, you can name a beneficiary and it will go to them tax-free. Your life insurance, you can name a beneficiary and it will go tax-free. Your principal residence will go through the will. It's tax-free, but it does have to go through the will. And then we have the red bucket where things are going to, so the the place where the government is going to get the most amount of taxes from people is from the RRSP or the RIF. Now, I did the math the other day because it was pretty fascinating, because I see this all the time where people have a large amount of money saved up inside of their RSPs because RSPs are very popular. It's what the first place where a lot of advisors tell people to save money, or maybe the second place. But what a lot of people don't talk about, and I've seen this all the time, I sit in front of people in their 60s and 70s who have a lot of money in their RSPs, but they don't know how much is going to go to taxes. So I did some quick math for different amounts of amounts of money that people have inside of RSPs and how much will go to taxes. Just so to quickly explain, when someone passes away, and let's say that in that year they had some pension money coming in, and then they also had some CPP coming in and some old age pension, that all adds up as income. And then anything that they own in the year they pass away that's in the red bucket is added to that. And for most people, a big thing is the RSP or the RIF. It gets tacked onto that. So I did some calculations last night to kind of confirm what that looks like for a lot of people. So I'll just do a few idea, and then I'll talk about what to do about this problem, because it is a problem for a lot of Canadians. So if someone has $100,000 in their RSP, even if that's all they had, even if they didn't have any other income, when they pass away, $23,000 is going to go to taxes when they pass away. And like I said, I understand why we pay taxes, but sometimes there's things we can do about this ahead of time. To move up a bit, if someone has $400,000 in their RSP, when they pass away, $175,000 is going to go to taxes. And what I ask my clients is I just say, what could your family do, or what could your church or charity do with this money? I get that the government uses it to, to pay for education and things like that. But most people I know would rather have a say as to how it's spent rather than just give it to the government to decide. And the final, and I see this every once in a while, if someone has $1 million or more inside of their RSP, they're basically going to send half of it to taxes when they pass away. In Ontario, sorry, let me move this a little bit. These are all Ontario numbers, by the way, which we're in Ontario, so that makes sense. $496,000. So what a lot of people don't realize is that the place where they have a lot of money saved up is the place where they're going to lose the most to taxes potentially. And I ask people, I say, if you knew of an investment where you could lose half of your money in one day, would you do it? Most people say no, but they don't realize that's what they've done when they put money into the RSP. Now, in case anyone's worrying and panicking, there are things you can do about it, and that's what I'm going to talk about. So I'll finish with the other things that are here in the red bucket. It is, so we've got the RSP. If someone has, here, let me center this a little bit. I'm trying to make sure it's as big as possible on the screen. Someone has a LIRA or a LIF, that's in there. What else? Those are the two big ones that I see a lot of times. Another thing that's going to be taxed, like I said, is if you have a cottage, that'll be taxed, but not nearly as heavily usually as these two things. These two things are taxed completely as income. So it's as though you got paid that amount as an income in the final year of life. So that's how, so these things, but you can name beneficiaries on these. So just to recap, these are, the B is for beneficiary. You can name the beneficiaries on these things, the LIRA and the RSP, but they still have to pay taxes on them. It goes to the person, but then the estate has to make up the tax. In all likelihood, this is where I'm going to get a lot of questions at the end today, because this is the part that when I sit in front of people and they show me all their statements and I add it all up and I show them the one-page estate plan, this is usually where I get the most questions. So I can come back to that happily. So I'm going to go very quickly through a case study of a client of mine that came to me and they said, Galen, we're worried about what we're going to leave behind. It's a married couple, a lot of money inside of their RSPs and with a daughter, and they wanted to make sure they left as much as possible to their daughter and to their church. And so when I first met them, they had an advisor for like 20 something years, but they had not gone through the exercise of figuring out where things were going to go. So this is where they started. So I'll talk about this over here. When I met them, we went through the exercise of the one-page estate plan. This is how their estate was going to be divided. So I showed them and I said, this is what's going to look like. you're going to be able to leave 48% of your estate to your daughter, 10% to your church, and 42% to taxes. So if you had to visually represent this, it would look something like this. If this is their whole estate, this is how much was going to go to taxes. And I said, are you okay with that? And they said, well, if we can't change it, we can't change it, but can we do something about it? And I said, absolutely, you can do things about it. So it took a couple of years. That's the other thing I'll say, is it isn't overnight where I can change these things, but usually within a couple year period of implementing different strategies, we can start seeing better numbers. So after 5 years of implementing a plan, they were in the position of now leaving 8% to taxes. So instead of, so this is what was before, was 42%. They were now going to leave 8% of their estate to taxes. Took a couple years, but basically the thing that I do is I move things from that red bucket to that green bucket. So if you remember the red bucket and the green bucket, most people, what they do is they just take out the minimum amount that they need to take out of the red one. And they sometimes don't take anything out of the green one, which is fine. But what I do over time is I move things bit by bit from the things that are going to get taxed to the things that will not be taxed. So that's how that works. And again, if I get questions on this, obviously I'm happy to answer them. The other thing was time that a lot of people don't factor in when it comes to estate planning is how long it's going to take to settle the estate. The more complex an estate is and the less someone has done to make it simple, the longer it takes. I have people who have it's taken years to settle an estate. Usually if it's because the person didn't make it abundantly clear what they wanted to have happen, that's what makes it take a little bit of time. And I'll just very briefly say, when I became an advisor, what I thought my job was to help people find investments that were going to perform well. And that is a part of my job, but it's a small part of my job, because especially with estate planning, I'm looking at how to save taxes, how to make things easy for the executor. And I just find that a lot of advisors are so focused on that rate of return, which in the last couple months, if anyone's been invested, has been a little bit chaotic. Luckily, I had my clients prepared for it, so we haven't had to deal with anyone panicking, really. But my job is really to help people get what they want when it comes to estate planning. Like if they want to leave a lot of money to their children, if they want to leave as much money as possible to charity, that's my job. And just if I focus all my energy on just trying to get a better rate of return, then a lot of time that would be doing my clients a disservice. So to talk a little bit about, this is the final, so the moving from the red bucket to the green bucket, one of the ways to do that very quickly is through a strategy that's actually been around for hundreds of years, but it's highly underutilized. And I'm going to talk about it very quickly here. I'm going to draw it out. So this was something that I found pretty fascinating when I became an advisor. It was a way to fix this problem. And like I said, I'm not sitting down individually with everyone who's watching this, so I don't know exactly what your situation is, but I have helped a number of people anywhere from 55 to 74 do this. And it's even possible to do it later than that, but this is something that I've seen work well. So when I sit down with someone and we look at their numbers, so let's say this big circle is the total value of the estate. So it's their house plus their investments, everything that's going to be passed along to that next generation. And we look at taxes. It's not uncommon to see nearly 50% go to taxes, like I said. Especially if someone has a lot of money in their RSP, it's basically going to be, something like this. Or sorry, let me redraw this a little bit. Here. Here. So, sorry, I'm trying to make sure I have enough room here on the screen and still make it big enough so everyone can read it. Now, so here's the person, who's going to inherit, or the person or the charity or the church who wants to inherit the loved one, who this person says, I want to leave as much money as possible to this person. Well, if they don't do anything about their situation, usually what happens, if they're in this situation where a lot of it's going to go to taxes, this is how much is going to go to the loved one, and this is how much is going to go to taxes. And I sit down with people and I map it out. I do the 1-page estate plan and I say, okay, we figured out if you had passed away yesterday, half of your money would go to your loved one and half of your money would go to taxes. And like I said, this is not true for everyone, but it is true for people who have a lot of money inside of their RSPs still, or maybe if they have a cottage or a secondary residence that's, this is not as common in this area, but when I work with people in Toronto, a lot of times people have a cottage up in Muskoka or something that, 40 years ago cost like $30,000 and now the land alone is worth, $1 million. It's a very big deal. So this is what will happen if they do nothing. And so I say to people, how about we take that money that was going to go to taxes anyway, and we take a little bit of it out early and we put it into an estate replacement plan. And I'm going to talk exactly about how this works. So what this does is it's something that actually everyone's heard of, and I'll say what it's most commonly known by in a minute, but a lot of people just don't know how it works. So I say how it works first, and then I say what it is. The way this works is you make a deposit, and the moment you make a deposit, part or all of that tax burden is going to be replaced when someone passes away. So what happens is this part that was going to go to taxes, what they say is I've made my first deposit. Once I make that deposit, that means that when I pass away, this will come in to help with the taxes, and my loved ones can actually receive all of my estate or all of my original estate. And what happens, and the reason why I can, in that case study, I was able to move the tax from 42% to 8%, is over time, as the person makes deposits, this actually grows over time so that it actually increases the total value of the estate. So each year, so just to kind of recap, every year, so the moment someone makes the deposit and they're approved, you do have to qualify for this. That's something I own this, my kids own this, my parents own this. Once you make that first deposit, the contract says when you pass away, we're going to come in and we're going to take care of how much you've decided ahead of time. And not everyone can replace the whole tax bill. Sometimes they can only replace half or less than half, but it just depends on the person. And then every year they take out a little bit from this taxable area to keep contributing to this. And they keep going. And this is something that's implemented by lots of people, certainly a lot of people who know that they're going to pay a lot of taxes when they pass away. And the beauty of this is if you go along long enough and you say, well, I'm no longer worried about my estate, now I'm worried about how I'm going to live in retirement, you can actually access this money as well. And I'm going to pause because a lot of times I talk about what it is I talk about how it works before I say what it is. Almost everyone who's watching this has heard of this. Not everyone implements it in this manner, but the way it works is, like I said, you put a deposit in, immediately there's a value that's going to come in when you pass away, and it grows every year. And some of the benefits of it are that it bypasses probate. So I'll zoom in on this a little bit. So it bypasses probate. I'll change the color so it stands out a little bit. It pays out tax-free to the beneficiary. It pays out quickly, 5 to 10 business days of passing away. It has a guaranteed component of growth, and it has a dividend component of growth that the company that I use for this has been paying dividends since the company began in the 1840s. The management fee is less than 0.5%. It has historically outpaced inflation. The growth is not taxed, which is good, and it cannot drop in value once it has increased. Once that increase happens every year, that value is now held for the person who paid for it. So I've talked about how it works, and what it is life insurance. Now, a lot of people haven't used this or don't know that this is what life insurance can do for them. Not everyone qualifies for it. It doesn't make sense for everyone, but for the people for whom it makes sense, it can be the biggest impact that people have in their estate planning. Like I said, I've done this for people in their 50s, 60s, and 70s when it makes sense, and it's a great way to help offset those taxes. Last thing I'll say, right, so when I sit in front of people, I know people ask me, they say, Galen, this sounds like this is expensive, like this is time consuming to figure all this out. What I'll say is that when I meet with people, so you can reach out to me. I'll give you my information at the end here. I meet with people, and what I do in my first meeting when I meet with people is I just figure out if I can add value to their financial plan, if I can make a difference. If I can't make a difference, I say keep doing what you're doing. But if I can make a difference, I encourage people to help me make that difference for them. So this is usually when I have a first meeting with people. I usually charge, so when I gave this talk a year ago on behalf of a group, I did charge for that first consultation. So what I do is, for anyone who wants it, you can contact me. I have a recording of a longer version of this session where I go over things in a little bit more detail. It was this version where I had more time to go over things. I'm also offering, so if anyone who's watched this video and is interested in knowing if this applies to them, you can reach out to me and I can give you a 30-minute consultation, where I can help you figure out your one-page estate plan if there's anything you should be doing differently. I also do a retirement projection, which is what not a lot of people have this. It's to make sure that they won't run out of money during their lifetime. I also do a portfolio analysis where people have statements from all these different places, and I put them all in one document so they can see how everything is performing. And then the last thing I do is an estate evaluation. So I usually charge up front for this, but since this has been put on very graciously by the Wellness Center, I am offering it first meeting for free, and usually I charge for it. But we talked about how for this, it's for anyone who's watched the whole presentation. They know that, have a good idea of whether I can help them or not. I'm offering that for free. And the way you can contact me is, I thought I had it here. I'll write it out then. You can either email me. Perfect. All right, so I know I went through some of these things a little bit quickly, but the 30-minute time limit is, I mean, I did it in 40 minutes, that's not too bad. Or it's difficult to go over some of these complex scenarios very quickly, but this is really what I find that people just don't know about when it comes to estate planning, and some of the big places that people can have that can change things through figuring out how much their estate is worth, making sure they're making the most of their beneficiaries, and then implementing some of the strategies to move from the red bucket to the green bucket.
Okay, well, thank you everybody for joining us. And Galen, if you could take your screen down for a sec. Perfect. All right. So thank you again, everybody, for joining us. And thank you, Galen. Great presentation. We learned lots and appreciate you taking the time. So everybody have a great day, and we will talk to you later.